summary of sections 35, 36, 37, 39, and 40. Okay, I believe if you understand what I've put down here, you don't need to go in and highlight those sections because we've covered it right here. So basically, all we need to know is that shares do not have a par or nominal value. You guys have been doing this in accounting for a couple of years already. They no longer have par value. Simple as that. Note, very NB, a company cannot issue shares to themselves. Okay, because you get an authorized number of shares that you then go and issue to people. You can't then issue them to yourself because how are they then removing out of authorized into issue if they ultimately staying within the company? Don't get confused here. You can buy back issued shares, which then will decrease your issued shares. Doesn't impact on your authorized because you have a set number authorized. You then go and issue some shares to increase the number of shares you have issued out, you've given to people. Then what happens is you don't want, or the people don't want the shares anymore. You want those shares back to give to somebody else so the business can buy those back, decrease the issued number, and then go and issue them again later. Okay, so you can buy back, you cannot issue to yourself. The authorized share capital is included in the MOI, so remember, if they want to change the authorized share capital, they have to amend the Memorandum of Incorporation via special resolution of your shareholders, or if the MOI allows it, the directors can do only this change. Changing the MOI to change the authorized share capital. That's it. All of the shares of any particular class of share have the same preference, rights, or limitations. So you can't say, because the share was given to this person, he's got stronger rights than any other shareholder. If it is ordinary shares that they have issued, then every single person who has one of those ordinary shares has the exact same right or privilege or limitation because they have the exact same class of share. Okay, one class of shares must be selected for voting right purposes. So this is for your shareholders' votes when they pass their resolutions. And one class must be selected as the net assets on liquidation. So who you're going to distribute the net assets to on liquidation. And I've just made a note here, it can be the same class of share. So guys, this is only applicable if they have more than one class of share. If they only have one class of share, then that class will be the class of share that determines the voting rights. So those shareholders have the voting rights to make decisions that shareholders need to make, and they will then get the net assets on liquidation if the company ever were to liquidate. Okay, existing shareholders of private and personal liability companies have the first right to subscription of new shares issued in their current shareholding percentage. So we're only dealing now with private or personal liability companies, and the reason here is because there's a restriction on private and personal liability companies. That's the reason why the shares don't get offered to the public, because they go to specific shareholders. It's restricted on who can have them. So when they decide they want to issue new shares, first offering goes to the current shareholders. Guys, would you like to take these new shares? And they get to have them in the exact same current holding. So if you've got Pete, who has 50% of the one class, and James has 25%, and Claire has the other 25%. This is the old class. So when they go and issue a new class of share, they need to offer 50% to Pete first, 25% to James, and 25% to Claire, because of this restriction of transferability of rights in a private entity. If it was a public entity, the shareholders don't have any rights. As soon as they issue shares, anybody can take them up. Okay, so private, they can restrict that. And then if these shareholders, if Pete says, no, I don't want 50%, I don't want any of them, then that 50% can then be split by the other shareholders, or the decision to invite a new shareholder. Okay, but private's restricted. And the board of directors determines the consideration for shares. We've just discussed how the board actually authorized the issue of shares, so they get to determine how much the shares go for, because they no longer have a par value, which is a set amount. Okay, nice and simple, guys. You can just work through this and you should be comfortable with that to pick up any issues that don't align with this in a scenario. Okay, so let's look at the issuing of shares. Section 38 deals with the issuing of shares, and Section 47 deals with capitalization shares. Put the two together because they're the exact same criteria, so we can look at it once and then be done with it. So any issuing of shares to shareholders, shareholders are going to benefit, so the board of directors makes the decision. There we've got it. Authorization by the board of directors. How do they authorize? The majority must vote in favor of the decision to issue shares or capitalization shares. So remember, guys, capitalization shares are for no consideration. You give it to shareholders and they don't have to pay for them. What is the requirement to do this? There must be sufficient authorized share capital. They must have enough available to issue. However, if they do issue and they don't have enough, so they issue in excess of the authorized share capital, they can then go and amend the memorandum of incorporation to increase the authorized share capital to allow this decision. Okay, they don't have to go first and increase the authorized share capital. They can go and issue the shares and subsequently amend the MOI to increase for the excess authorized. How do they go about doing that? Either the shareholders will pass a special resolution to amend the memorandum of incorporation, or if the board of directors are allowed to change the MOI when it comes to authorized share capital, the board can go and do so. But remember, as soon as the memorandum of incorporation has been changed, they need to then go and file notice of the change. Okay, just to note here that if the director made this decision to issue shares in excess of the authorized share capital, they could be held liable for losses if they attended the meeting and failed to vote against that decision. Note here, guys, if they attended the meeting and they chose not to vote, they will still be held liable because they didn't vote against it. They have to specifically have voted against it for them to not be liable for decisions made. Okay, so any losses that are incurred as a result, directors could be held liable. So then, what happens if there are shares that are issued to directors? So note here, Section 41 deals with shareholder approval for issuing shares in certain cases, and those certain cases would be if the shares are issued to directors or a related party of a director or a related party of the company. Then they need to have a special resolution passed by the shareholders. So it's important, guys, to see that they're not only looking at a or shares to a director. It is to anybody who is related to that director. And they also say anybody who is related to the company. Okay, so it's not only now specific to a director, it's any intercompanies, subsidiaries, holding companies that now, if shares are issued to them, a special resolution will also have to be passed. I've also put here, or if shares are greater than or equal to 30% of the voting rights that are issued, that a special resolution will also be required. Okay, so they're giving such a significant amount of shares in this issue that the shareholders must be involved. Okay, let's quickly go have a look at section 38. So here it is. It says, the board may resolve to issue shares at any time, but only within the classes and to the extent that the shares have been authorized by the MOI. Okay, so they're in the Memorandum of Incorporation of authorized shares. It does, however, say if a company issues shares that have not been authorized, so ultimately they would be in excess of the authorized share capital, it can be retrospectively authorized. How is it retrospectively authorized? In accordance with section 36, which is authorization for shares. And if we quickly go to 36, it is in paragraph 2, which deals with authorizing of shares can be changed only by amendments to the MOI via special resolution or by the board if the MOI allows for it. Okay. If it is not retrospectively authorized, so they don't go and change the authorized share capital to increase to allow for this significant issue, then the share issue is nullified and the company must return the fair value of the consideration together with interest to the shareholders that purchased. Okay, they have to then also go and nullify those share certificates that were issued. Okay, and then we've discussed how directors could be held liable. Alright, so add here what has to happen if it's not authorized. You need to pay back shareholders with interest, and they need to cancel the share certificates. Okay, section 41, which is dealing with where a shareholder approval is specifically required. So if it's a normal issue of shares to any shareholder or potential shareholder, we don't need the shareholders to approve, only the directors. However, if it is to a director or a person related to a director or to a company that a director is related to, then there needs to be a special resolution, which is that greater than or equal to 75% of the voting rights present at the meeting must vote in favor of giving these shares to directors or somebody related. In addition to that, if the shares that are being issued exceed or equal 30% of the voting power of those shares, okay, then a special resolution is required. So two criteria. One, if the shares are going to directors or anyone related to a director or anybody related to the company. Or two, if the shares are going to anybody whatsoever, but the amount that is being authorized is in excess of or equal to 30% of the voting power for those shares. Okay. Quickly, let's do this class question. I'm going to give you guys 5 minutes here. Okay, I want you to think a little bit. How would you audit the transaction where the issue of shares was in excess of the authorized share capital and the decision was not retrospectively adopted by the shareholders?